Hello, and welcome to our second quarter strategy review. As usual, most of us met in this room, but I, on the other hand, was in California, and on your screen you may see a picture of me sitting in the sunshine with a golf course in the background and my computer, but I did have on my SR Shill hat. So that was where I was. I was participating over the phone. On my right, Len, CEO, Vice President, was sitting here in this room, and on my left was Bob Toomey, Vice President, Director of Research. And on the phone with me was Dean Amundsen. Dean has met with us on a number of occasions. He manages a very large bond portfolio. And as usual, bonds did take up, and Fed actions and all the other things that go along with it took up quite a bit of our time at the meeting. But we'll get into that as we go along. Right now, I'd like to turn over to Bob to talk about the equity markets.
Thanks a lot, Stan. So I'm sure those of you that keep track of the stock markets probably have to be asking, wow, what happened? If you look at the wild swings in the market over the last 2 quarters, they've been quite amazing, and actually very rarely have we seen such volatility like we saw over the last 6 months. We saw a decline in the stock market of about 14% in the fourth quarter, which closed December 31st. And then in the first quarter of this year to date, through today's close, the market is up 15%. So and that's again measured by the S&P 500. So we've actually recovered all that we lost in the fourth quarter. And really the reasons for that volatility have been fundamentally, I think that there were concerns over the Federal Reserve policy in the fourth quarter of last year with Jerome Powell's famous comment about autopilot. I think that really caused investors to become very concerned that the Fed was just going to continue to raise rates in the face of a slowing global economy. And then I think the other big issue for the volatility we saw in the fourth quarter was concern over the trade issues with China. And as we've moved into the first quarter here, year to date, both of those issues seem to be improving. The Fed is now clearly on hold in terms of its rate increases, and we continue to see positive news relating to the trade situation with China, or the China trade negotiations, let's put it that way. So I think the market's optimism on trade has been fueling part of this increase we've seen recently. I also believe the market's become more confident about the U.S. economy. Appears to be very stable. As you know, with the unemployment and the employment figures look very strong. Consumer looks strong. So we see that the U.S. economy as being quite stable. We do see some green shoots, if you will, of improving global growth. That has been due to better signs out of China that their manufacturing sector is improving, and China is also trying to stimulate growth through various measures in their economy. I also believe that we're going to see corporate profit growth being fairly slow here in the first half, but there are clear indications that in the second half we should start to see corporate profits actually improving on a year-over-year basis, and I believe the market is beginning to discount some of that. With respect to interest rates and inflation, those continue to look very subdued, and we expect those to continue to remain on the low side. So the direction of least resistance right now, we think for U.S. stocks, is upward. And with that, I would like to turn over to Len to talk about the international outlook.
Thank you, Bob. On the international side, there's really no place that we prefer in the rest of the world to the U.S. Right now, the U.S. market seems as strong as anybody. There are a number of different issues that we discussed and that we're keeping an eye on. Britain continues to have all kinds of trouble coming up with some kind of a deal to exit the EU, and whether they end up coming up with a deal that works or whether they don't is probably going to affect Britain a whole lot, but probably isn't going to affect the U.S. an enormous amount. And we're kind of just watching that, but we're not responding to that in any great way. What we have responded to is the idea that since we don't like most of the rest of the world, we're going to be underweighting in the international area. And we're maintaining our focus on the developed economies. So we're looking at the EFA index, the Europe, Australia, and Far East area, and emphasizing that without having any emerging markets. With that said, there's a great deal of talk right now regarding the ongoing negotiations with China and what kind of a deal we may get there. And with those negotiations in an uncertain state, it was unclear to us exactly how we wanted to invest for that, depending on whether or not it would or would not ultimately lead to a deal. So we set a trigger. In fact, we set two triggers. One if the talks completely fall apart, and one if the talks should go ahead and result in an agreement that everybody is satisfied with. If indeed it does result in an agreement that we're happy with, we will decide at that time to move into emerging markets and introduce those back into the portfolio to some extent. But unless such a deal does take place, we don't really want to invest in that, and at this time we won't. With that, I'm going to turn it over to Stan to talk about REITs.
Thanks, Len. Looking at the REIT markets, they also participated quite well in the previous quarter, and we've continued to like the fact that we do get a high dividend return on the pass-through that is available through the REITs themselves. We had in previous quarters invested away from the regular REITs by bringing in the medical REITs, and that has actually been a very positive step. To that end, we actually tended to increase our holdings in REITs a bit, and again to capture the higher dividend, and it also would reflect the better, at least not a negative, U.S. economy for the consumer. With that, I'd like to turn it over to Len to talk about fixed income.
Thank you, Stan. As was mentioned earlier, we did spend a fair amount of this meeting talking about interest rates as well as Fed policy. Our feeling is that the Fed is going to continue the pause that they've already started in terms of raising interest rates, and that we don't really anticipate any more raises with the possible exception of one later this year, but certainly nothing in the way of an aggressive movement up. We continue to emphasize treasuries rather than corporates going forward, and we are emphasizing the shorter end of the curve right now. We are underweighting long-term bonds. We are underweighting intermediate-term bonds. We are overweighting short-term bonds primarily to bring a little bit of additional income into the portfolio in a world where cash isn't generating as much as short-term bonds would. To offset the possibility that short-term rates might go up and take advantage of that a little bit, we maintain a position in a floating rate fund on the short-term side as well. With that, I'd like to turn it over to Bob to talk about changes in our holdings.
Thanks so much, Len. Well, both Stan and Len talked about some of the changes in REITs and fixed income. We did do, I think, some very significant work in this last meeting on what I'd call restructuring of our model. I think it's going to make it more streamlined and more efficient. And I think it's going to enable us to better focus your money on the areas that we think are going to be most productive for you. So we're very positive about this change, and I, as research director, feel very, very positive about the outcome. And you will see some of that when you look at your portfolios going forward. We did increase equity weighting slightly in the quarter, largely through an allocation to higher allocations to small caps and REITs, and also natural resources. As Len mentioned, our bond allocation was fairly constant. It was down a little bit. That was largely because we decided to de-emphasize the intermediate duration and in favor of shorter duration bonds. With respect to sector investments, as you know, we do like to look at sectors that we feel are attractive to add value to the returns in your portfolios. Within the large cap stock area, we added a new ETF called the SDY is the ticker symbol, but it's the SPDR High Dividend Appreciation Growth ETF. We like this because these are companies that have a long history of raising dividends. They tend to be less volatile in terms of their stocks, and we think this is a way to enhance ultimate value and growth in your portfolio with lower volatility in the large cap area. We continue to maintain exposure to medical technology in an ETF called the IHI, which is the iShares Healthcare Medical Technology Index. This ETF has done extremely well. It has a number of very high quality, high growth medical companies. We continue to believe strongly in this area and believe this is a great way to capture long-term returns in the medical sector. We're also maintaining a position in the telecom industry because we feel that as a sector, it is somewhat undervalued, and we still believe that it's a good, solid growth area with many companies in the telecom ETF we're using. Many of those companies have very good growth prospects in areas such as networking and other types of telecom technologies. Again, as Len mentioned, we continue to hold a floating rate ETF in the short-term bond area as a hedge against rising interest rates. So with that, I'm going to turn it back to Stan for closing comments.
Thanks, Bob. And as far as the overall meeting went, I think you got the feeling that we didn't make substantial changes in the portfolio direction. However, as indicated, we did do some simplification of the portfolio, and I think you'll notice that as you see your statements in the coming months. However, we did talk about triggers. Len mentioned the trigger, and I'd like to emphasize that, but not forget the trigger that we set last quarter. Triggers are designed to not be used, and they rarely are, only really been used once in the history of the firm. But this quarter's trigger was having to do with an inverted yield curve concern. The concern being that if you got an inverted yield curve, you would be looking at potential recessions in the future. We watched it again closely. We actually saw the yield curve invert between the 3-month and the 10-year bond. We were actually looking for the 2-year versus the 10-year bond, which never did invert. And the fact is, even though the 3-month, 10-year inverted, it caused a 1-day movement downward in the market, which was corrected quickly, and that has since changed. We are back to an uninverted yield curve. So we didn't take any action, as we usually don't on our triggers. However, this quarter we set triggers, as Len mentioned, about the Chinese trade talks. We do feel the Chinese trade talks can be very important to the way the markets react, and we thought we would look at it two ways. If the trade talks did collapse, we would be uncomfortable and actually reduce holdings. How would we identify that? We said if we got back to some of these 25% tariffs, which would be quite onerous, that would be the triggering event. However, we also said what happens if the talks go well, which frankly most of us felt more comfortable in that direction. But since we're not quite there, we did say, what would that trigger produce? In that case, we would add to our emerging markets. So with that, I'd like to say again, thanks for attending, and we'll look forward to talking to you again next quarter.